So the top level view here and the deep dive that we're going to go into in this first part of it is we're going to know the different types of investors. You're going to understand loans versus and equity, the two of them and the versus them. Liquidity and also marketability of property, the different characteristics of property, how to strategically quantify risk. How do you figure risk? How do you look at it, right? And then the different types of real estate investments, how to break down the math and figure out how does it make sense? How do you figure out how it makes money, when it makes money? How do you optimize that return, which is even more important? There can be an opportunity there that you don't make money because you didn't optimize how you did it. That there are different types of alternative investments. And then there's really generic type of investments that conservative, people know it, and it's done every single day. And investments vary as much as people do. So there are a variety of different investments as much as there are a variety of different people. And connecting those two is really the biggest piece of the puzzle. So there's income, there's profit, there's growth that people look for, when the growth being selling out and getting the value add, or in a development deal that you're getting the 30% for developing it, that you take your profit, you make a profit. Some people look for interest income, some people look for dividends and rents, and other people, their ultimate goal, their whole purpose is they get all their capital back, or what it costs them to get into a deal, all the cost basis, not just the money, but the cost, and they make an income on top of that. And then you have people that are really committed to fixed income. Some people like the variableness of variable income, so they get the highs and lows and the feeling of almost like gambling. Then you have the high and low return guys, like what they're looking for and their strategy for why they're looking at it. And the appeal of investors for lower returns that are very safe and conventional, the higher riskier spots that you can be in where there's more risk and what your strategy is based on your time horizon, and value investors, people that look to invest into development deals and then build value in the development and then exit for a profit. So we're going to dive into all that in this program, detail by detail, so you understand it in a very simple way. Real estate made very simple. In order to understand how investors think, you really got to take a dive into how investments work. I mean, you could look at almost everything in the world as an investment of some kind. The phone you have is probably a depreciating asset, right? You invest money into it, it loses value, but you have a use for it. Light can be an investment. But let's talk about how people look at investments, because the types of investments, understanding how they exist and why they exist and what moves those markets will help you be able to talk about your deal or look at investing in your deal or creating a deal, right? The ultimate, which is originating something out of nothing. Now, the most common that you'll hear about are stocks, homes, right? People invest in their home, a 401k that they've pulled out and maybe invested in the stock market, could be a CD at a bank, right? Or it could be a bond that they've bought, could be a treasury bill. All these are like really common investments that people make. Now, what's more or less common, and you'll see as you grow and really start to grow in the investment class or to look at investments, is you'll see that artwork can be an amazing investment, but it's less common. So you have really common stuff that everyone's pretty much aware of, and then you have your less common stuff that the deal makers and the bigger money or the smart money moves to be able to get the higher returns. There's art, there's land. You could be banking with land. They have land banking, where you typically, if you want to buy a piece of dirt that you see that roads are coming to, you may just buy that dirt waiting for the roads to come up, which will increase the value of the highest use of that land. And in the current moment, maybe the highest use is just simply grazing the grass that's on it. And you entitle the property to agricultural, so you get the tax benefits of lowering that. But you have a solid place to store capital because dirt's not moving, right? That dirt's not going away. So when you invest in that, you're basically getting out of, let's say, the US dollar or whatever other assets that could be different variables, because this land is not going anywhere, and you solidly invest in it. A lot of people don't think, but there's huge companies and individuals that land bank their money to keep money safe, and they'll lock it up in like a trust. That's not, they're only a beneficiary to that trust. So the trust is very protected, and the money is very protected from anything happen, because there's no moving parts when it comes to land, right? They fence it, it's solid. And there's a whole section on land banking. There's apartments. There's high-end apartments for people that are, you know, basically would buy a house but want a luxury apartment, which is a huge class in Las Vegas now, to regular apartments, to, you know, your lower income Section 8 type places where people are getting their rent compensated by the government, which gives you a certain benefits for that, providing low-income housing when it comes to apartment. Could be retail. And retail could be an A property, which is really on a busy corner. It's really strong during almost any market. It could be a B corner, which is a little bit placed back, not as busy. It could be C or even D property. And those, during different market cycles, go up in value or really struggle when the market goes down, because businesses start failing and the vacancy of the retail starts to increase. And as it increases, your profit decreases, and if you're debt servicing that, you could find yourself in a world of hurt. In a lesser property than, say, an A property on a busy street, where those businesses that are doing well will move into those properties during those tough times, and they'll move out of the B, C, and D properties towards the high volume stuff. And basically, during those economies, the best of the best really thrive, because all the guys that are just barely making it can't make it anymore. So you'll see the businesses that survive those cycles, because we have 4 different market cycles, and I'll go into that at another time. But they're basically recovery, expansion, oversupply, and recession, right, where it recedes. So there's 4 different market cycles, and they go just like that. So you'll have recovery that starts to go up, it'll start to grow, then you'll go into oversupply when you've got too much, and then once you're in oversupply and the market demand is not there, it'll start to recede down that line, and it'll recess all the way to the point where you get to a baseline where it bottoms out, and then you start to recover again. So you have 4 different cycles there, and every single investment class traditionally is in some stage of that cycle. You have tenants in common. Now, this is, it was a huge vehicle right before the crash. People would syndicate TICs so that you could buy a piece of, say, a Walmart center. So you have a whole Walmart center, all the leases, everything done, and you send it off, and people look at all the leases and how stable those leases are and the likelihood of there, and they can invest a smaller portion, and they can buy it as tenants in common, right? So TICs are still popular. Syndicated investments are really popular in some of the bigger centers. Development is a huge sector. It's less common. I'm involved in development. It could be development of apartments, could be development of industrial, office. There's different types. Assisted living, which is another one of my favorites. I've entitled Assisted Livings Bought and Sold, and that's a huge segment. Again, maybe not sexy for some people that are look at the older crowd, and they don't want to confront the fact that that's where all of us pretty much go. At some point, most likely, is into a home where we need assistance to live. And a lot of times, our younger generation or kids are not able to take care of us to the level that we need to be taken care of when they're out trying to make a living, right? So those pockets, depending on population growth and age growth, create different demand cycles and how much there is available to meet that demand. And those revenues are all based off those models. You have life insurance settlements, which are, you know, people that are actually selling off their life insurance policy to bigger companies, and then people invest in those. based on the timetable. I used to call them death bonds, which is not a sexy name. I thought they would outlaw them, but they're still going till today. There's lawsuit lending, where you can lend on what would be recovering. So if somebody's involved in a lawsuit, you can give them upfront money knowing what the settlement will be later. And then there's investments, again, that are less common, where people invest literally in bankruptcy. So if you see in bankruptcy, you'll have maybe debtor in possession that has the property, and you're able to lend money there, and you're under the safety net of a federal judge to make sure you get paid back in order for them to get out of bankruptcy. So you have federal jurisdiction basically enforcing the fact that you have that asset tied up in a federal court in BK that you've lent money to, that is secured by that. You can't get out of it without that court order. And some people, it's not common. Most people think of bankruptcy as a scary place to be, but they're actually, you could invest there even for property, or invest in helping some of the financing, and literally have a security that's in first position in the bankruptcy that actually gives you more leverage over the overall investment if the bankruptcy judge approves it. So that can be a huge way. And I've seen people buy hotels out of BK and do the same thing and make incredible money by doing that. And that's something most people, you don't hear about. If you're a bankruptcy attorney, you know about it. If you're a skilled investor or a broker, you may know about it. Most brokers don't know about it. I just happen to look, talk, and research all this stuff. I love it. I spend 2 to 4 hours a day just studying, because I love doing this stuff so much. So there's lots of different types of investments. There's common investments, and then there's less common. I'm more involved in the less common, obviously: land, apartments, retail, TICs, development, BK lending. Those are all the vehicles that I like personally, and I like working with investors on that, because those are the ones that I believe in the most. Some people like CDs. They don't, they just want to have it secured and insured. Move their 401k into stocks, which is not my game. People buy stocks. It's not my game. And bonds are too boring for me. So I like a little excitement. I got a little ADD and OCD. I like a little game in my investing, right? So the next thing we're going to talk about is, what are the different types of investors? So there are really 4 different types of investors that I see, 2 different types, and those are just individuals. It could be a bank, corporation, or an institution, right? So when I think of an individual investor, I think of like a single person, just an individual person. Can be a small group of people. I still consider them an individual. Maybe it's 2, 3, 4, 5, 6 people, even up to 22. You can do small LLC type units that everyone can invest together, and it's like an investment club to buy something. There can be small partnerships, or it could be a small business. To me, all those are like really individual people. Businesses, one person, small group, or a partnership. Those are what I call individuals. Now, corporations, because I actually deal with all these different segment classes, right? Because I don't discriminate. I work with them all. So corporations could be public or a private corporation. Could be a for-profit or non-profit corporation. So any types of corporations, I think it's smart if you have excess cash in a corporation that you invest that in real estate, whether you buy or you lend against it. I think that it's really dumb that you don't take part of your business and actually entrench yourself in some piece of real estate that you're investing in, or some investment class, so that you're looking outside of just your business to make money. Because a good business should have multiple streams of income that flow into that business, that help it survive, that can take it through some of those tough times where sales might be down. Maybe your interest or dividends or debt payments actually surpass the income that you're making on making the business run. So those are things to really look at, that you build a base in your business. So the others are institutions. These are pension funds, insurance companies. I love insurance companies for the most part, because if I'm a long hold, I like long hold stuff as well as development, short and profit. But long hold stuff, if you go to a life insurance company, for example, insurance companies are generally looking for long-term annuity type investments. They're not trying to do 5-year, 10-year terms. They're trying to do long-term type investments. So they don't look at the short-term They're like, they want to place it and forget about it. So you may pay a point or two difference more for a life insurance company, but on the flip side, you may get a lower rate of return for a longer period of time, which life insurance companies can be big wins for getting capital to place in investments that you don't have to worry about a 5-year time horizon to refinance or a 10-year time horizon where your term's up. And the other one, which I really think about as sort of an investor, is the banks. Banks always look at deals like they're investing in them because they've got to deal with them if you drop the ball. They've got to take it back. They've got to operate it. So when I'm structuring a deal with a bank, I think about a bank as a partner. Typically, I'll put everything in a single entity, an SPV, special purpose vehicle, and I sign everything and make sure all the deed and everything is in that corporation, and then the estoppel I give to the bank so that if anything happens to me or anything happens to the asset, my bank is protected. Like literally, they can step in my shoes. No tenant's going to have a problem. Nothing's going to be interrupted. Taxes will be paid. The lights will stay on. Everything will happen even if I'm not there. To me, I think that's just being responsible for what you're going to do. Now, that's worst case scenario. But typically, all my investments are set up in a way that banks really feel comfortable knowing that they're in a position, if something should happen to me, that they're not going to be damaged, right? And that talking underwriters through that so that underwriters really get that my ethical level is actually to make sure that not only do I protect myself, but I protect my bank that's invested in me, and they know my track record. So I'll build the foundation with the underwriter, breaking down their concerns, what their concerns about the property are, what the concerns about the asset is, what the concerns about the submarket are, what their concerns might be about me, what they might be about the tenants, what it may be about the people in the area, or whether people are coming into an area or moving out, what the demand is like. And I'll work with the underwriter to understand the 3 different values there, whether it's income approach, market approach, or the actual build. Those 3 different type of approaches and really address them. And then when an appraisal comes in, I read it and I talk to the underwriter so they understand how to structure and secure the deal so that the bank's comfortable lending in a deal, because a bank's like an investor with me. And it could be an investment bank. So there are different types of banks as well. I go to credit unions as well, which are a totally different climate because they're nonprofit. A nonprofit credit union, a lot of times they have lots of cash. Nobody walks in for a loan. And you walk in and they invest in real estate, they invest in commercial. Nobody thinks about a credit union. You walk in there, they're like so nice to you. Hey, can we help you, right? So credit unions are typically not set up the same way though. They're not in a position where they just make deals all the time. So you really have to walk through it and get them comfortable because they are a not-for-profit company. Credit unions typically will pay dividends back to you. I have money in credit unions. They literally pay me to store my money there because I'm literally a member of that credit union. So when you open an account there, you actually become a member. And as you borrow money, I've had credit unions come back to me and say, hey, how come you have money with us, but you got loans with other people? Can we do the loan for you? They're actually stealing loans from my other bank and willing to give me better rates. And the relationship is there. So it's real different when you start to really get involved in this game and you look at people like partners and you look at people like growing together to make money. You'd be shocked how it comes together and how when you have those strategic aligned goals with different institutions, how fast your wealth can grow. So here we talked about the different types of investments. The common ones, the less common, stocks, bonds, 401ks, CDs. We talked about less common, artwork, land, apartments, retail, TICs, development, life insurance, lawsuit lending, BK lending. We talked about the different types of investors, whether they're looking a user business, income, or appreciation, to set goals so that you know what you're going to do. And then we talked about the 4 different types of investors, whether that's an individual, corporate, institution, or banks, and how to look at those different, how they look at it, and some tidbits on what you can do to use all those different investors to either work with them or to help them achieve your goals as an investor, as a buyer. So just with what I've just gone through, Literally, I've given you millions of dollars in value. Literally. And let me explain. Just lending in BK, where maybe you go get a credit line for 3 or 5%, and you're lending in BK at 12 or 18%. Right there, you could make millions of dollars doing that. Land banking, even getting people to land bank and property that you know is moving and being part of that, you could make millions with that. Apartments, TICs, right? Lawsuit lending, being able to buy a lawsuit lending. All those things you could make millions of dollars on, either by putting deals together where you don't even put money in, helping people that have money find those deals, or basically getting involved yourself in them, and the different types of users, and about buy your actual property that you're leasing from. That alone, to a business that's paying a lease right now that can get in a position to own their property in basically 10 years, they literally will have $1 million or $2 million in their property. It could be $3 million if you have an even bigger property that you're leasing for the same money. Because when you figure the income approach is typically one of the values they look at to cover the debt service. Typically, if you're leasing, your lease payment covers the debt service by 130%, right? Because a bank looks for a debt coverage ratio of 1.25 or 1.3. That means there's 30% margin there that goes to the person that actually owns the property, because the bank doesn't lend otherwise. Just the information I gave you, you can make millions of dollars, literally. Just knowing this, just even getting involved in the conversation and playing some part, you can make as much as you make at your job, right? I'm not guaranteeing you will. I'm not saying you will, because I would say most people won't, and most people won't make a dime. That's just reality. But if you take advantage of these opportunities, they're opportunities. And the outcomes, they could go either way. That's why they call them investments. There's risks involved. So doesn't mean you will. Me personally, I have. I've used these. I've been part of them. Every one of them that I'm talking about in some way, shape, or form, I have personal experience with it. So I know that this stuff is gold. And I hope that you see the gold in it. There are different ways you can be placed into investments. So you want to look at it a couple of different ways, right? And there are different advantages to each. You want to look at the investments as, the type of investments as, let's say, lending versus equity, or loans versus ownership. And they're really two different things, and you can intermingle those two, which you have to be very careful in different states about what states you intermingle debt and equity, because it can be a real problem if the investment ends up in bankruptcy. How they look at those completely changes the outcome that happens when deals go bad. So typically when you're lending, you're going to put yourself in a first place position, and you're looking, when you put your principal in, that you're going to get all your principal back and you're going to get interest, right? So it's a typical loan, and you can get placed in that loan, and maybe you take just interest only. So you don't want any of your principal paid down. You want to get paid simple interest, pure, maybe 10% on your money over the course of a year, and you want to leave your principal there. You don't want anything amortizing to lower or create any debt equity in it. So your debt stays solid, so you make a pure 10% per year, right? So the whole effectiveness of why you would lend is because you establish a rate of return. A rate of return that you can feel comfortable with, typically, because you're in first position on the property. If they don't pay you, you take the property using your debt instrument, your loan, your deed, your mortgage, to be able to, like a deed of trust or a mortgage, you're going to use that to basically pull back that property to you because they weren't paying you. So you're in a position where you have fixed interest that you're making. You can be placed in that. Also, they have corporations that will, can be placed in it, either private or public corporations. The other types of lenders too are banks. You have corporations, governments lend. Typically, these are in the form of a bond. A bond is basically just a debt instrument, right? It's not equity, it's not ownership. So when you hear about a corporation and people buying bonds, those bonds are basically debt against the assets of that company. I know you typically file like a UCC-1, which is Universal Commercial Code, that basically they have a position. Uniform, I'm sorry, I knew there was something that popped in my head. Uniform Commercial Code, right? So that basically gives them an interest in that to where they can recover it legally, right? Because they have a first position on it because they lent money against it. So that's a bond. A mortgage is another thing. A deed of trust is another. A land contract is one. Or it could be a mortgage-backed security, right? Or an asset-backed security. Now, what does that mean? A security is simply when you grab lots of different pieces of something and you package it together, you create like a secure instrument, but because there are several different aspects of it, it turns into a security at that point because it has lots of pieces to it, right? And it can be packaged. So you've heard a lot about these. And there are different types of loans that you can do. You can even do loans that, you know, the interest, you do an interest only, you do a negative amortization where it actually, the principal actually loan grows because they pay you less and you're tacking it on to what you're going to sell it for later. So maybe they can only afford in the lending that you're going to do 5% of that 10%. Then what you'll do is take that 5%, you'll tack it on to what you get when they sell the property so that you give them enough relief as far as the payments. But on the exit, you're going to get paid a certain amount. Or maybe they can't debt service that, and you're just going to tack that on to the loan as you go because they can't afford you to pay the debt. Maybe there's no income on the property yet because they've got to make it habitable so that you can move somebody in it. And there is no revenue coming off of it. You don't want to cripple the people that are actually doing the project. Sometimes waiting for your money because there's no cash flow is very smart, because you don't cripple the project and you give people the air, the space to be able to put it together. Most people don't think about these things. They have fixed ideas, and that's what I'm trying to do, is get you out of your box. Start getting you to think outside of your box, because deals can be structured so that everyone wins. You don't have to be in a situation where, because it's done this way, you think, like you might not have thought about a negative loan where you're actually increasing the value, or that you're carrying your interest and you're tacking that on to the when you dissolve them or sell it off, right? And everyone gets paid. And because you're in a first place position, you're able to sit there, and maybe you have payments that start to happen that you're going to go ahead and advance fund all the interest payments. The other way, I talked about lending, the different types of loans, but the other way that you can place people, you can get placed in a property, is as an equity position. And what does that mean? That's ownership, right? That's the concept of ownership, which is completely different than lending. Lending, you're in a first place position, they don't pay you, you take the property, right? In an equity situation, you're an owner, right? So you're not in a position to simply take the property because you're not getting payments, right? That's a debt instrument. You're now an owner. Your problem, their problems are your problems in a partnership. You share the responsibility, right? Now, there are different types of partnerships, and I'll get into that in just a few seconds, but that shared sense of responsibility is completely different. People have the mindset that they go in as a lender when really they're a partner, and now they share the problems, and if they're in bankruptcy, they could get wiped out by the debt if there's debt in front of it. And they don't realize that equity sits behind debt, like in a stock. You know, the bondholders get the assets before the people that have equity. That equity could be becomes vapor stock, pieces of wallpaper that you can wallpaper your room with stock certificates, because the bondholders are the ones that have the debt in the UCC-1 against the property. So they'll be able to take it first. They're in first position before equity. Equity sits behind debt as an owner, right? That's how our structures are typically done, is debt's in front of equity, right? So when you're in there, you get the same problem. So if you're placed as an owner, you really want to look at, do you like what comes with ownership? Or do you like what comes with lending? What do you like? What do you want, right? And what are the risks associated to it? Because maybe you don't want to be an owner. See, let's say you take your ownership as a stock, right? If you take it as a stock, you're part of the stockholders, and whatever happens in that corporation, you're part of the mix. If they spend all the money, they fix up the property more than they should have, they pay themselves, whatever it may be, you ride that ownership piece. There's also, as a proprietorship, I would not recommend that. I think I like doing everything in LLCs and corporations myself, or trusts, but never as a proprietorship. There's a partnership where you can be partners, which is, again, real close to proprietorship. I personally, I don't like partnerships naked. I like limited partnerships in corporations where if I'm going to, let's say, for example, somebody else is going to run the company, I'll want that person maybe to be the general partner if they're going to operate it. They're going to sign on the loans. They're going to be responsible. They'll be responsible if there's any fraud, any lawsuits. If I don't get my money or my ownership is impinged, they're the ones that are ultimately responsible because they're the general partner. And then maybe I'm an investor and I'm a very limited equity partner, right? What does that mean? That means I'm limited. My exposure is just towards what I've invested in the property pretty much, or into the investment. That's it. I'm not a general partner expected to do certain duties. That's what when you want to assign duties to a general partner and you want them to almost be a noose around their neck to make sure they do the job, and they're the ones that are personally guaranteeing the debt. They're the ones that are going to go get the debt. And you're going to sit as an owner looking for the exit strategy, but say, I'm going to help you get there, right? As a limited partner, you don't want to help somebody get there, and then on top of that, their mistakes as a general partner sit and position you off in a whole nother thing. The stuff I'm talking about, you want to get good legal advice for. I'm not giving you legal advice here, right? I'm just telling you what I do. Now, if you want to really structure this well, spend the money up front to go to an attorney. Get these deals structured right. It's so much cheaper for you to get a deal structured right with an attorney, tell them what you want. They've got the templates typically, and they structure a deal that's, they've been through the problems, can help you with it. It's so much cheaper than the hundreds of thousands of dollars. You can lose all your equity in a lawsuit. Soon as, somebody, a partnership, and somebody says something's happening and it all goes sideways, next thing you know, you have a lawsuit. It can eat up all the equity, all the value you've created can disappear overnight in legal fees. And then you have someone that's going to determine your future about what's going to happen. And then even if you win, you still have to recover. And recovering, you don't want to be in a position where you have to go chase. It is not fun, right? So I call that chasing bad money, right? Good money is making it. Chasing bad money is just hard because people will fight tooth and nail to make sure you never get it. So this is practical advice, right? That I'm sharing my experiences with you, but get good legal advice, set your structures up right. Some states you can do loans and equity together. You can put them in different types of companies too, but you want an attorney to set it up properly, or professional. So as practical examples for like a loan versus equity, let's say, for example, you're a owner and you're in an equity position. Well, the building itself gets a write-off, but any interest that's paid on that is actually a write-off as well. So depending on your structure, you may love or like the write-offs and you should seek a professional tax advisor, but you may like the benefits that come with being able to be an equity partner in a deal. The other thing is, let's say, for example, you like the roller coaster of the variable market conditions. You look at it like, I've got this fixed return if I lend them the money, but if I'm a partner and I have 25%, if I put $1 million in, I could come out with a 50% return if we can get this done right and make $500,000 in a shorter period of time. So let's say it's going to take them a year to get in and out of the property. That's a 50% return, right? So if you lent the money and you looked at it and you went, okay, the most that's really fair here would be if it's a hard money loan maybe it's 12% or 15% and make a couple points. So at best, with all the risk and the brain damage and everything I'm doing, I'm going to make 6 months or a year's worth of interest on that $1 million. I'm going to make maybe $100,000 when I can make 5 times the return by playing an equity role in that piece. And it could be that I'm, in a position where I'm a second behind a first. So if it really goes bad, I could be wiped out in a second place position. So I said, you know what? I'll go ahead and take an equity position because I get some benefits tax-wise, but my return goes through the roof. I get a 50% return on my money rather than a 10% return on my money. So that might be a scenario that really excites you, because if you flip that money several times, you could make 100% of your money as opposed to a fixed rate of return. Now, if somebody's looking for that investment and they go, well, maybe they're coming in, they want a lower fixed rate of return, they're not going to say, yeah, I'll give you 50%, because they don't know where the project's going to go. And 50% on your money just seems egregious, right? But from an equity point of view, it shifts the thinking. The thinking completely shifts to a position of where you're going for profit now. You're going for the exit strategy. You're on the team called let's sell this thing and make some money. Where with debt money, you want it to stay there as long as you can, especially if it's safe, because you make money off of it being there a long period of time. You don't want them to borrow money and pay it off in 6 months. Maybe they get better debt. So the other thing is, as a lender, if you lent the money, they can get rid of you pretty much at any time unless you write it in the provision. Like, for example, if we go through all the brain damage in some of these business loans that I structure for banks, there'll be what's called a 3-2-1, where if you pay early, you have to pay 3% of the whole loan. If you pay within the first year, 2% second year, 1% the third year. So by the fourth year, you can literally pay that off without a problem. So you need to really look at, when you do deals, like when I package them for the SBA, whether that's 7A or 504, they're not looking to go through the brain damage of packaging that and selling it on the market and getting that government insurance policy for you to just simply pay it off right away, right? So there are different types of debt instruments. So those are 2 different scenarios that you can kind of look at. From a lender, you're looking at security, first place position, you're looking at fixed. You don't want any ups and downs. You're not interested in making more. You just want to know where you're going to be at the end of the day and know that your value against the asset is covered, and you can go sleep at night. You don't have to worry about if they overspend, if they spend too much on flooring, if they spend too much on the roof, if they spend too much on management. You don't have to take a look at the financials at all, because you're just simply a lender, and you get paid and then they pay their expenses. You get paid and then they pay themselves. You get paid and then they pay all the rest of the stuff. Otherwise, you take the property back. So it's a really different situation, right? So, and the other thing is, when you're an owner, when things go bad, let's say, for example, the project hits a hiccup and you're halfway through doing it and you find out that your slab that was poured doesn't have the right PSI, right? That's pounds per square inch, right? Your actual compression to be able to, say, hold up concrete walls if I'm building a commercial subdivision. Now, once I put those walls and the concrete starts cracking, and I'm 6 months into a project, we realize that we've got to cut up all that concrete. We've got to take it out. We've got problems with maybe the foundation underneath it, right? That we've got to now straighten that out, recompact it. Maybe there was a water table that got a pipe buster or something that eroded underneath and the slab messed up. Maybe because when we pour slabs, we'll have big mixers, and these mixers come out and they literally vibrate all the concrete to get all the air to surface out of the concrete so that the concrete has more structural strength. So you have all the rebar, and then you have all the concrete, and then you vibrate this concrete. And I've been out at 5 in the morning where we're just vibrating concrete to get it to a strength where the PSI is correct. If you don't do that foundation correctly and that slab correctly, when you put up concrete walls on those footers and on that slab, you're putting enormous amount of pressure on it. If you find that now 6 months as an owner, if you don't have the coverages, let's say you're building it yourself, or maybe that contractor can't afford to do it, you could find yourself in a position where you just completely, your investment got wiped out, right? Wiped out by the fact that you've got a problem that you can't cover, maybe your insurance. Now, of course, you get builder's risk, and they have insurance and that sort of thing, but maybe they can't cover it. Maybe they're just about to go out of business. I mean, these are just hazards you go through when you're building and development. There's lots of things that you have to be ultra conservative and concerned about when you're developing projects, because any one of these setbacks could completely wipe out the hopeful 30% return on your investment when you sell it. So this kind of gives you an idea of what the hazards and risks are between an equity or a loan position, and what can happen even in a development project. So here we went over the types of investments and how you can be placed in investments. The loan types, whether it's your principal and interest payments, how the rate of return works, how you play, whether you want to be placed in as a lender, or whether you want to be placed as an owner, whether it's public or private corporations and governments, bonds, securities, or whether you're in equity position, and the type of equity and how those play into a deal. Whether you want a variable return or whether you're coming from an investment standpoint, because you really need to say, how am I looking at this? Am I an investor or am I an owner? Because those are two different realities and they're treated differently in the legal system. And then how you structure it, whether it's stock or a partnership, sole proprietorship, or a limited partnership, and the different distinctions there. We're going to talk about liquidity and marketability, right? Liquidity and marketability. These are investment characteristics. They're characteristics that you want to think about when you're looking at a particular asset, right? Whether it's real estate or anything else, art, bonds, stocks, whatever it may be. You want to make sure that you understand certain characteristics about that. And these are investment characteristics that you need to look at every one of them and evaluate where you're at with it, right? Liquidity. What is liquidity? So liquidity is how fast can I take an asset and convert it to cash without losing my principal? How fast can I do that? So, for example, when I do loans and I package a loan and I'm going to be a debt person on a project, I may need that cash back to put it into something that's more favorable. Now, in order for me to sell off that debt, right, that loan, I typically have to contact somebody I know who is also a debt purchaser, and I sell the debt to someone else. I may have to take a 5% or even a 10% discount in selling it to that person. I may even have to guarantee the fact that that loan's going to perform, and I may even have to say that I will buy that loan back. Like a lot of times when I'm selling debt, I'll give 3 months or 4 months or 6 months to really show goodwill that I'm not handing off something that's going to default, and then maybe I ask for 95% of the total note price that I have, the value of the note. And that's present time value. That's how much principal is owed. They're still going to owe their interest. So liquidity, as far as a loan goes, is one thing. For an owner, it's how fast can I sell it and convert that into cash. Let's say, for example, it's a stock, right? Stocks traditionally, you're able to convert that pretty fast. The stock value is what the stock value is, and the trade, maybe it's a little less, maybe it's a little more, maybe you lose a little bit of money, maybe you make a little bit more money depending on the trade, but it's pretty fluid, it's pretty liquid. That's why people like, if I'm going to move $1 billion into a market, or $1 million or $500,000, and I want to make sure I have some access to that money, of course the most liquid would be like a bank account or cash that you hold. That's completely liquid, right? Because you can spend it, you can do what you want with it. In stocks, there's trading volume, and I know that, okay, I can sell it, I have this much stock and there's volume, so I can instantly convert that into cash and come out of my brokerage account. With real estate, it's considered a lower liquidity, right? It's considered lower, but more stable for most people because they feel good knowing that it's really there, right? There's something physical there. There's real estate. It's real, right? So, but it has that low, like if you need the money to use it for someone else, if an opportunity comes up, you could be stuck, especially if you're in an equity situation and you're not able to sell off that note. You might sell off part of the interest in that to get some liquidity, but most likely if you're selling off interest in it, you're going to probably take a bit of a loss in your principal to move it quickly. Like there's always a market if you're willing to discount it to where that market would be to move it quickly. So that's one of the problems with liquidity when it comes to real estate or debt in real estate, is that it doesn't have the type of liquidity of, let's say, a CD that maybe you pay a little penalty on and you move that money out, or a bond that you can then sell off to somebody else, or whatever that bond's trading at, you can get bond money. So those are pretty liquid instruments. The other thing to think about as far as liquidity, because maybe you really don't care about liquidity, you want it locked up, you want guarantees, you want to know it's there, you'd rather have it out of the dollar, maybe in ownership for appreciation. You want to, next thing to look at is marketability. What does that mean? Well, marketability is how fast you can convert an asset to cash at any price, right? It's how much demand is out there for this particular item or this particular asset class. That's marketability. How much of a market is there? Is it a big market? Is it a small market? Are there big players? Is there demand in that market? Because the higher demand, you might find yourself even making more money because people want to be in that space. If it's industrial and industrial dries up and the vacancy rate's there and you have a user that wants to buy that industrial space, your ownership in it before you even sell it, you could find a user can buy it for way more than you would sell it on the market because he's looking at it running his business, not necessarily looking at it as an investment, but an owner-user. And there are different decisions people make when it comes to that, right? So in marketability, it's how fast you can convert an asset to cash at any price. And with that, in marketability in real estate, there's all kinds of different submarkets. Submarkets being little pockets in different parts of the city. And those different pockets in the city have really different demands and different supply. There might be a lot of supply in one market and none in another, right? So give you an idea as far as, like, let's say an end user using a property and how marketed it will be. I had a shipping company, and with the shipping company, you know, having a property built right next to the airport gave us incredible access to all the different points of Vegas inexpensively, right? So truck gas, think about gas. Gas prices go way up. We're not coming all the way from way out of town, which is where most trucking companies are. We're literally built and situated and right here. So literally, we're right to the airport. Literally, we're right on the 15. We're literally right on the 215. When you look at the cost of what that gas is and the distance it takes and traffic, you could find yourself paying less out, but you don't have an operator that's really done the math, that just for a little bit more, all the particular trucks they have rolling and their docks and where they're at and the savings in gas far outreaches, if you're operating your trucking company correctly, you could pay more for a piece of property, which will give you more. That sub-market would be stronger because it makes more sense for an operator to be there because of the savings from distance and gas and time, because you're paying an employee sometimes all the way from there, which could be an hour drive, and all the way back just to dead end and park their truck. So that you give up 2 hours of somebody's work time plus the gas, right? And then traffic. So that's something to think about when you're thinking about marketability, right? So we've got liquidity, we've got marketability. The other thing is leverage. When you're, and this is another characteristic of an investment, you've heard of, or maybe you've heard of, where you borrow something, your loan to value. Now, what loan to value is, it's basically, or loan to purchase, which banks are using a lot more, or loan to value, they're saying whatever's less. That's a new market trend now. Before in the market, before 2008, you could literally lend, they were considering market, what the market value price was, not what the purchase or what the cost was. But now they go by the lowest of whatever those items are. So they squeeze any potentiality for you getting money out of a deal, because the bank doesn't want to put themselves at more risk. So they reduce that loan to value as low as they can. Traditionally, a lot of investments, you're looking at about 65% loan to value, or loan to cost, or loan to purchase, right? So if it costs me $1 million to build, then they'll give me 65% of that, $650,000. I've got to have the rest some way, somehow. It could be in the dirt, right, that you're getting the rest of the value by billing, but they're going to lend to that. So if the building's worth $1 million, they're going to lend about $650,000. So I got to find a way to make that work, so the bank, leverage-wise, is in a position where they're not compromised. Because if there's no meat on the bone, why would I hang around? Maybe I just walk away. If there's nothing in it, like that song, What's in It for Me, right? With them, right? So if there's nothing in it for me, if it's an LLC and I haven't personally guaranteed it, what's to be, I'm not going to walk away from it. Why deal with the brain damage? Why sell the property if there's nothing in it for me? So banks don't want to own the property. They don't want to be property managers. So they want you to be responsible. So they lend it so there's enough meat on the bone for you as well. The other thing about that leverage is they want to make sure that their loan can be covered, right? Their loan to value at 65 typically means that you can debt service that loan, and then there's extra proceeds that you get to put in your pocket on something that's, say, already built, right? So those are things to look at as far as leverage. The higher the leverage, the greater the risk to the bank, right? So if it's 85% loan to value, which people don't, I mean, that's very rare that you ever see something like that. That's only 15%. And if you're selling that property, and let's say you have to pay 6% in real estate commissions and 2% in closing fees, that's 8%. And then you've got another maybe 7% worth of whatever miscellaneous stuff that hit you, or maybe the buyer wants a discount by 7%. You don't make anything there. So the bank realizes that if there's no check coming in escrow, there's not a lot of motivation for you to sign on the dotted line. So leverage is very important. You have what's called non-recourse and recourse. So if you're getting leverage, non-recourse means they don't come after you. They just take the property, right? You haven't signed a personal guarantee. Recourse is you say, you know what, I believe in this project so much that I'm willing to stake my credit, I'm willing to stake my house, I'm willing to stake. I'm all in, baby. So, and of course, banks like that. They want to be able to attack everything you have to recover all their costs that they could possibly have on a property. So if you lose it and there's a bunch of damage and there's vandalism and it's uninsured, that they get to the point where that particular asset is covered, right? So that brings us to another thing, which is another characteristic that you got to think about when you're looking at property, real estate in particular, or any asset for that matter, is managing that asset. So you're either an asset manager, managing an asset, or like a property manager. See, a property manager is handling the day-to-day. They pay the expenses, they handle the stuff, they collect the rents, they make the reporting, they handle whatever the common interest community maintenance fees are. Those are all your associated costs. Let's say, for example, you got to pay for your fire, right? So we'll pay Alarmco to monitor the alarm. We pay another inspection company to check to make sure that the systems are all checked. We have an elevator company that comes in and they check the elevator to make sure it's okay. Then you have power. There's general areas that you'll have power that you have to pay for. You have the maintenance outside. You could have some of the units, air conditioning units, that have to be replaced for common areas or some other areas that are part of those common area maintenance. And that's where a property that has a ton of deferred maintenance, those costs can end up eating away all your possible profits on a building, depending on how long you're going to hold it and sell it. So the property manager really manages that day to day. Now, an asset manager can sit on top of typically like maybe a property manager, because they manage lots of assets. It can be lots of assets that an asset manager is taking care of. right? So they're in the business of managing maybe multiple assets, right? And they manage the assets. You also see banks have departments where you have asset managers there. And a lot of times those asset managers not only watch to make sure and monitor those assets to make sure that there's nothing happening, that the rents are there, they look at the reporting, make sure the tax filings are proper, and that there's the asset is not deteriorating in its income. Maybe you have a bad operator that's not leasing out as much space as they should, and the vacancy rate goes up, and therefore that asset, the value of that asset's down because the income approach has been lowered because you're not producing as much income. So all those things play into it, and a good asset manager is watching those returns. They're watching it, but they're not handling the day-to-day. They're watching the sub-market, they're getting a good idea of that, and also the asset manager typically handles if they have to take the property back and get rid of it. So you'll reach into the asset manager and say, hey, you got any properties you want to sell? Which those are great opportunities to get property, sometimes at a discount because they don't want to market it and sell it and deal with all that. You can literally get wholesale properties, and the reason they do that is because marketability. How fast can they convert it? If they give a discount to a property guy like me, then I say, sure, I'll deal with the brain damage. I'll take that property. I don't want to buy it on the open market and pay all the fees. So they discount it for what the cost of the fees to even promote it, maybe give me a little bit of love in addition to that, hopefully, and I pick up an asset from the bank. So, and that happens every day. People buy large portfolios of assets from banks because banks don't want to be in the property management business. They don't want to own property, right? You've heard of REOs, bank-owned properties, right? Or real estate owned. They don't want a big REO because they also have to cover all those because they're no longer booked assets that are making money, which is what they're in the business of lending, right? That's what they do. They're not in the property management business. So the other thing you want to look at are what are the tax implications on a particular market, you know, like a racetrack that I was buying, $28 million in 6 years, I could write off all of that on my taxes. And of course you have to check with your tax professional, take a look at it, but planes, I believe this year you can write them off in a year. You know, different asset classes have different tax strategies associated with them. Oil is a big one that has tax advantages. Let's say you're buying rights to a well, or you're buying acreage that people are going to actually pull oil from that, and an oil company is paying for the lease rights to be able to and they're giving you a rev split on everything they pull out of the ground. A lot of companies will sell off that stuff to create liquidity, and then they'll lease it back from you, and then they'll pay for the oil that comes out. Those are another way of real estate assets are mineral rights in the ground, especially in Texas and North Dakota. There's different places like that are out there. So, and that leads up to the real big picture item, which is your rate of return. That's your yield, what you're getting. What are you going to get out of investing that money? So your rate that you return capital, right, is very important. Like say, for example, if I have a 10 cap on a property, I'm getting 10% of the value of that property back to me in cash every year. Like that's the cash flow on that, and that's a cap rate, right? So you could have a 4 cap, a 5 cap, a 10 cap, and depending on those cap rates, different industries, different market segments have cap rates that are pretty common in that area. You can go to California, you could have a 2 cap. That means 2% of the total value of the property is coming back to you in a year. It's pretty low. Doesn't debt service anything, and you can you got to put a lot of cash in to cash flow that, right? Because it doesn't make as much yield to be able to cover any debt. But you take and you have a 5%. Now that may be okay in submarkets that are strong submarkets that people are actively buying and people feel comfortable that it'll move quickly. But then you might have a 10 cap, which means you lowered the cost so that the income, 10% of it, and that's typically for somebody who's looking for a higher rate of return or a higher yield, will buy that property because they see that. But a lot of those cap rates can be deceiving. They can look really good, but there's a lot of deferred maintenance, there's a lot of problems. So your effective cap rate, if you manage the property correctly, could be about 2%. So those are the things you want to look at is your overall, and I'm going to talk about this next, risk, right? Risk is so important. What I find is that the wealthier people I know, the rich, the super rich, they manage risk. They don't avoid it. And the people that I know that don't have a lot of money, they avoid risk like the plague. They don't, they're not investing even small amounts, not even CDs or anything like that, or investing in just what they can get into in order to grow their investment. The best way is to start investing. I don't care if it's $5,000, right? You may not even be a qualified investor, but get an investment where you don't have to be a qualified investor. But get investing, get involved. You need to invest money for your future. So this is just my personal opinion. You earn money, but you need to take some of the money you earn and take that and lock it away, store it, invest it, and let it grow. Because you may depend on that money at some point in time just to cover your daily costs and expenses so that you can get through a tough period in life. Life comes in seasons. You have summer, you have winter, you have fall, you have spring. So if you're in a winter and the market's down and the jobs are hard to get and money's not flowing, you don't want to be stuck in a position where you can't cover what you have that you've worked so hard for. So I'm going to talk about risk next, and we're going to dive into risk hardcore and break down the fundamentals and the characteristics of the basic risk patterns. So of course, I can spend probably months every day talking about all the different exposure and risks. I'm not going to do that. I'm going to sum it up into some basic characteristics that are pretty common, and we're going to go through that. Most awesome part, which is risk, right? Risk, most people are afraid of, right? It scares them. You really want to get excited about risk like a game. Like you got to get involved in this. I want to tell you that if you really get this, this will change your life, because it filters into so many different areas of life. And it may not sound like much, but if you really dig in, think about it. If you're avoiding risk, your life gets smaller and smaller and smaller. So will your portfolio, so will your investments, so will anything in your life. When you avoid risk, right? And when you're careless with risk, which is dumb, right? Where people just don't care about risk at all, right? Then you end up with all kinds of other problems, right? So a lot of people would just avoid risk. Now, the difference between people who have money and people who don't have money traditionally is how they manage risk. It's very different. Think about that. Avoid smaller keeps you from doing something. You won't do anything at all because you're avoiding it. You're scared of it. But when you learn to manage risk, and I'm going to help you understand how to manage it. And most of the reason people don't manage risk and rich people manage risk is because they've learned how to evaluate risk and they know how to manage it. So we're going to bust some stuff up in here that if you really get it, should change your life. It should change your financial, your personal, every part of your life, right? It'll be the difference between you going for it and managing your downside compared to you just not doing anything at all. And I don't care whether that's personal or business. This is so fundamental shift as far as a paradigm. And it's the area that most people avoid altogether. They don't even want to confront it. They don't want to talk about it. They want to talk about it in a deal. Even when they're being sold a deal, they don't even want to talk about it then, like about risk. And yet, that's the place to really start. Right? What's my exposure? Right? So let's talk about risk analysis. First of all, you want to look at as far as alternative investments, right? What are those risk levels and what is your tolerance? What does tolerance mean? So tolerance is how much can you handle? Can you handle losing a little bit of money? Can you handle losing 10%? Can you handle losing 5%? If you go into a business and you can't handle losing money, if you go into a real estate project and you can't handle losing money, then get out. Yes, the game is about making money, and yes, you set it up to win, and yes, you strategize, and yes, you plan, and you insure, and you do all that stuff. But if you don't have the tolerance, then don't play in games that have high risk tolerance. Play really small risk tolerance games, right? Say, for example, like a savings account, okay, where your risk tolerance is like 1, right? You don't have to worry about risk pretty much at all compared to, let's say, 10, where you're almost like rolling the dice, okay? So, and a high risk, like if you were going to get a marijuana license when the federal government could clamp down on it any day, you're in that high risk tolerance level of like 10. I mean, you could crush it if the federal government says, hey, it's all good now. But if they don't, you could find yourself in a really bad situation and losing a lot of money that you put up because you were going for that alternative high risk investment. So if you can tolerate it, then I'd say go for it. Now, the other thing is risk allowance, right? Well, you can allow a certain amount of risk. Me personally, you know, I assess like, okay, what's my tax exposure? How much capacity do I have to fix something? And what's the leverage on something? I'm not going to leverage something like, for example, if I was in the cannabis business, I would have partners, which I'm not in the cannabis business, but I consult with them. I would make sure that everything was paid off and I had equity partners, not debt partners, right? Because I can't count on the cash flow. I can't count on the federal government. There's a lot of variables I can't handle. So I'm not going to leverage up that. I'm going to partner up, but I'm not going to leverage up, right? Because I don't trust it. To me, it's a 10. I'd love to be in it, love to play in the sandbox, but if everybody isn't an owner, including the property, the license, everything, I'm not taking any debt against something that has a it's like super risky. I'm rolling the dice. But with a one, I will be more than happy to put leverage against it, right? So real estate to me is probably a 2, right? So I don't mind leveraging up real estate, considering if it's a sub-market, I believe in it, and it has marketability, it's pretty liquid as far as being able to sell in that market. Now I've like really have an understanding of it. I'm good with real estate. I know if I leave it, the dirt will probably still be there. The building will probably still be there, right? So my tolerance there of actually losing what's there, of it going away, is probably not going to happen. With the marijuana license, maybe it goes away with the federal government. Those are big variables. So there's variable risk. And a lot of times, some of the solutions to handling some of that, because you want some of that fun variety of risk in your life, is put a small amount in something really high risk. I'm not being a financial advisor. I'm saying this is what I would do. I play a little high risk over here that's a little bit fun and gets my juices, because my ship could come in over there. That could be $1 billion business. Ooh. But it also could be nothing. Right? Like VCs will invest in 25 companies, they'll go nowhere. They invest in another 25 companies. One nails it and pays for 50 plus 100 more companies, because the multipliers are so huge because they get in early, right? So, but their risk tolerance is high because they know most of those businesses are going to fail. That's why they invest in 25. Maybe not a lot of money. Maybe they'll lend $100,000 to a company, see where it goes. And then if it evaporates, they're not going to go chase their money. Like on a blackjack table where you lose and you put more money down, they go, okay, our risk tolerance was $1 million. You lost it. We don't hate you. We're done. We're a VC. We invest in projects, but obviously this one's going down the tubes. Their risk tolerance, they cut off their exposure. They're done. They don't go down a rabbit hole, right? Sometimes they will if they really believe in a project and they still see the hope there, but they may just cut it off. So it's important that you diversify that possible risk into different areas. Now, I personally like to be in very conservative investments, like savings or CDs or bonds, and then have more higher risk that get me excited that something could happen. And you know, if I lose that money, I'm not going to lose a ton of sleep. I'm going to be super disappointed because I hate losing, but it happens. I knew that that was a possibility. But if I have 5 of those investments and one of them hits, it may pay for all 4 and flip into something. So maybe I put smaller amounts in higher riskier stuff that I'm not so concerned about, me personally. That's how I vary risk, right? The other way is that I manage risk is insurance. So if I'm building a project, I get what's called the builder's risk policy. I go down to the insurance company, I say I want a builder's risk. I want to make sure whatever I build, if there's something that happens to it, I'm going to be covered for that builder's risk, right? And I know that if the lumber gets stolen off or the wire gets stolen or something happens or it burns down, that place is covered. It's not the contractor's fault that it burnt down. I'm the owner, I'm the one that's got to take care of the property. I'm going to go buy a builder's risk policy. fire, that there's no sprinkler set up in something I'm building. If it sticks, I got concrete and sticks, and someone lights a match, the whole thing burns to the ground. The contractor is not responsible for that, right? Just like, for example, when I'm building something, I make sure that I pay for framing when framing is installed and done, right? I'm not responsible for the supplies that are sitting on the ground at my job site. I don't want to be responsible for that. I'm not responsible for wire. Wire, when it's in and installed, I'll pay for it. If somebody steals it the next day, well, that's on me. I'm not paying for wire, right? So everything that I do when I'm putting in my contracts, I make sure that it's at the last stage when it really becomes my property. Up until then, I consider it their personal property, not my personal property. I'll pay for it when it comes time. I look at, you know, anything that gets installed on the property, that's when I'll pay for it, not before. I don't want to own the personal property that someone can walk off. Job sites are notorious for everybody coming around. There's 50, 60, 70 people that come in and out, different trades. Things disappear. Nobody seems to know who took it. And maybe there's 10 guys and 8 of them are in the back, and one walks off with something he needs at home. And I'm not paying for those sheets. I'm not paying for the boards. I'm not paying for the extra wire. I'm not paying for that stuff. So I'm not going to babysit my job site and make sure that that stuff gets to where it's supposed to go. I'm not going to run down that rabbit hole. So me personally, in all the development, that's certain things that you just learn, and there's probably 100 other things that I can go into, that day to day you just have to manage your risk. And I manage my risk that way when it comes to lumber or sheetrock or wires or anything, by simply saying, look, when it's installed, I'll pay for it. And that's when I own it, not before. Right? The other thing is, when I pay for product, I always two-party check stuff. So any of the material supply that could come back and lien my property, I'm making sure I'm getting clear title to that property, so they don't come and lien the property and say that I didn't pay for the wood that was on the property. I want to make sure that wood is getting paid for, that it's not used on another job, and maybe he paid with my money, he paid another bill that he was over, and he's floating his cash flow, which many contractors float their cash flow. Subcontractors float their cash flow. So they literally haven't paid for the materials that hit your job site. So I write a two-party check. I will write it, it's for this job, it's the contractor and the supplier. I manage that risk that way. So anywhere where you can see, okay, I can manage risk this way. I can manage risk by my materials. I could manage risk by a builder's policy in case things burn down. The other thing I can do to manage risk as far as building something is I can require the contractor to give me a performance bond. If I've signed a lease and I got somebody coming in, a user operator that wants to put a restaurant on a pad, and I'm building the pad and I'll ask that contractor, I want a performance bid. If you don't get this done in 12 months and that person isn't ready to move in, I want to be able to come after the damages that could be damaging my cash flow and could be damaging the person that's going to lease it or maybe own it that I'm selling it to, because now you're putting me at risk. If the market changes in 3 months, let's say, for example, I had a project that was going to finish September 28, 2008, right? Finished. The market collapsed and my bank failed September 5th. If I had a performance bond on that, and it was supposed to be done in August, literally I'd be completely safe, because my exposure for that market change would have been enormous. At least there would be something to argue when I go talk to the attorney and say, look, man, I had this sold, I had all my stuff sold, I was ready to be out of it, and they didn't finish the project. Here's the performance bond. The bonding company comes in and says, yes, this guy committed to having it done by this date, and it's not. And these happen all the time. Big contracts with governments typically have performance bonds that they request because they don't want to play games. They want to know their timelines. They want to know when it's done. They want to know when they're going to be finished, right? So you can get a performance bond to help protect your time, because time in real estate is money, or lots of money if you don't get it done in time, right? Early is great. Late, not so good. Late, and those eggs could rot. You could end up with a rotten egg in your face if you're 6 months to a year later than you thought, and you did not plan for that, right? So a performance bond can protect you against that. That's insurance that you can buy to protect yourself. And there's lots of other types of insurance. You can cover the property that's on the place, just pay an extra premium, but insure everything that you can possibly insure, especially if it's cheap. If it costs you $10 to get a coverage, buy it. Buy it. $20, buy it. If the difference between $1 million and $2 million is a few bucks, pay it. Trust me. Your limits, you may need all of them, right? So make sure you insure it. It's just part of being prudent, right, with your investments. Don't be cheap when it comes to managing your risk, right? Because that cheapness could cost you. So, and read your policies, look at them. They're usually the coverage just bust out your risk, what it covers and how you take care of it, and to spend the time. They sell you all like crazy about all of it. Learn what you're really covered for. So when you see something happen, you go, I'm covered for that. If that happens, I'm covered for that. I'm covered for that. I'm covered for that. Because you don't want the drama of that in your life if things go bad. You rather, I sold that risk off. I paid a small fee today to make sure that I didn't have to worry about that. And yeah, they may win, right? The insurance company may win on that trade. Because the insurance company is pulling all these different things together. And yes, things are going to go bad. One thing goes bad in your life, your whole life blows up. One thing goes bad in a risk portfolio of $1 billion is really not bad. It's just, it's nothing. It's last month's premium for them, right? So they can just pay it and take care of it because their aggregated risk factors, basically their algorithm that they look at, their actuaries say, yep, we're fine here. Our exposure is fine, and that pool of money allows them to take care of something that could crush your life. They'll take care of with a check in 5 to 10 days, typically. So you need to shift that risk, right? Another way you can shift risk is through lease terms, right? So if you buy a property and you see that the lease terms are 3 years, and you really don't want to have the exposure of that term, you may want to renegotiate those leases prior to going in that property and make sure people are going to stay there for 6 or 10 years. Maybe you give them an incentive to do that because you don't want to worry about that. If you have a 10-year term loan and you're going to have to refinance, you may want that tenant in there past that term, past that 5-year term, so that you can still use those lease income and the business there as value in the income approach. So you want to move that lease so that lease is protecting you and your investment, right? The other thing is, in your leases, I always write that any operating cost that increases or tax increases will be the exposure of the tenants, because I want to pass that off. I want to know that I've passed off and shifted that risk of increases to the tenants. And you might say, well, that doesn't seem like that big of a deal. But what happens when your taxes double because the value of the property doubled? Now your tax exposure is pretty huge. Nothing's changed in your world. The income's still the same. The lease is still the same. The operating costs are still the same. But guess what? Now, now your property taxes have gone up, and they're eroding what you were making. And if your margins were thin and your cap rate was low, you may wipe out your cap rate just with taxes because the value of the property went up. And the other thing to realize about value, and this is another piece of information that should save you thousands, maybe even millions over the course of your real estate investing, and nobody does this that I know of really, and I don't know why they do it. So this here information, this tidbit, this pro tip should pay for anything. I mean, this is gold. When you get your taxes mailed to you every year, they ask you if you want to challenge it. If you don't agree with the values, I've found more often than not that I've been able to cut my taxes down by simply saying that this is what I think the property is worth. I have deferred maintenance, I have less parking, I have this, whatever my stumbling blocks are with my piece of real estate, I point out all the bad stuff to that tax to say everything, oh, this is horrible, oh my God, it's bad, right? And I show that, and they look at the value and they agree with all that. They'll discount the value, you pay less in taxes. That's real money in your pocket, tax savings every year, because you're never getting out of paying property taxes, right? That's what pays for the police department. That's what pays for the fire department. That's what pays for your basic services is your real estate taxes, right? That's why they're so expensive. So you challenging that, and it comes out, if you don't answer that within a number of months, that bill is unquestionable the rest of the year. You get one opportunity once a year to challenge that bill. Now, the funny thing is, I had the opportunity to go challenge to reduce a bill, And in a particular property, I actually had a cap rate. So I asked, I said, what's the deal on this? He goes, this is capped. I don't care if you decrease the value of the property, because you're capped, you're going to pay this amount anyway because you fall into this cap range because you applied for the cap and you got the cap. And I said, yeah, that was a pretty smart move on my part. So I had a cap. So if I would have changed the value, when you type in the public record, the value of the property would have decreased by $1 million because I challenged it. Yet it had no tax implication on me. Do you think I challenged it? I didn't challenge it. I'd rather the values show a real strong positive value, so when a bank Googled or pulled up the value of the property, I didn't want it to be reduced on public record for the bank to take as what the value of the property is, especially if it had no tax implication on me at all, right? So what I'm saying does have variances. You have to look at the full picture. The tax guy is there to serve you, right? Your property tax guy, when you go in there and ask him questions and you read your tax bill and you question it and you ask about the cap, they're there to help you, right? My guy, when I was talking to him about the cap rate and when I was sitting with him, he had a smile on his face while he was talking about the strategy, and we were talking about the strategy of leaving the price alone so that any bank who looked at it knew the value of the property, that it was high and it was beautiful, and yet it had no tax implication on me. So that alone is a pretty big step. It may not sound like, but your linchpin, the basis, the first property right in the building, if you don't pay your taxes, they can take it from you, right? The other is managing risk, is how you form your ownership. Those are a lot of legal questions that you need to dive into, how you want to own that property and take title to the property. There's lots of different vesting ways to do that, which you want to look at. In the state of Nevada, there's about 4 different vesting types. You can Google them, ask your title company. They traditionally have an attorney. They can ask you about the different types of vesting, because each vesting type could have a different tax implication that actually hits you, and that exposure to taxes that maybe you wouldn't have had or that you can't share with another person because of how you formed and how you're structured. So taxes are a big way that you can shift some of the exposure and some of the cost, and if you make losses or you get to write things off, to be able to share those with people that are part of that ownership. So you want to be able to take a look at what's the best ways that you can manage that, and again, a good tax person that you can talk to and a title company to say, okay guys, if I hold title this way, what's my tax bill? If I hold title this way, what's my tax bill? Well, how is this going to work? And if I can write these taxes off and I have this person who's partners in the project, how, if they want to get certain taxes write-off, or maybe I want to get the write-off, how do I form those relationships for how I hold title legally so that I reduce my tax liability, right? And I reduce my overall exposure because my yield is going to be higher. And most importantly, what I'm talking about with all this is due diligence. Do your due diligence. Like look, confront it, right? You make a decision, one decision, that decision could impact your life for the next 10, 5, 20, 30 years. So read it, look at it, ask questions. There's lots of people making money off of every transaction. And they're professionals that do it every day, so they learn lots of stuff that you don't know. Reach, ask for help. These people are providing a service to you, whether it's a title company, a broker like me, a business broker like me, an investment guy that invests and develop like me. You know, I've paid $45 million in, education and mistakes and projects and everything like that. So, I'm not going to pay for something twice. That's just stupidity, right? I'm going to pay once. So I'd hate for you to have to pay. I'd rather just provide you with the experience so that you don't have to go through some of the pain that I went through, right? Because that's learning. And if I'm sharing with you something that you don't have to go through and you see the value in it, then you don't have to pay the price I did, right? Or the upsets I went through. So, think about it. When you talk about avoiding risk and managing risk, if you're really interested in your personal life into somebody, going up and asking them if they're interested too, or just even finding out if they like you, what's your downside risk to that? What's your downside, right? If you manage that with a clever conversation, it's better than avoiding and going years and not knowing if you really like somebody. So to me, it's kind of universal when you think about it. right? Be willing to reach, be willing to ask, be willing to be rejected, and be willing to lose, but manage your losses, your downside losses. The worst case scenario, if you ask her or tell her she's beautiful and you're interested in her, is she got paid a compliment? Maybe she's not interested in you, you're not her type, no big deal. The downside risk is that you just paid somebody a compliment. And what? So maybe I manage my conversation and go, look, I find you attractive, and if there's no interest, then I want to make sure that I've paid you a huge compliment to say that you're somebody that I would be interested in, right? What's the downside risk to that? She's sitting there listening going, oh my God, he's interested. He thinks I'm good looking. I'm taken, so I'm not interested, but it's nice to have somebody that thinks I'm attractive or would consider me as somebody they'd want to be with. She gets a huge compliment, you feel better, and your doubt, you evaporate it. Now you know that there wasn't a chance anyway. So your exposure there is really nothing other than, at the end of the day, the interpretation is you just paid somebody a compliment. Now that we've got a baseline, that we've gone over different types of investments, what you want to do is, just for your own practice, so that you have the ability to really analyze deals, is I want you to make a column, a right-hand column on a piece of paper, and write savings. Underneath that, put bonds, and then right underneath that, put publicly traded stock, and then right underneath that, you're going to write collectibles. Then right underneath that, you're going to write precious metals. And then right underneath that, you're going to write real estate, right? So each one of these things on one side, you're going to have all the different asset classes. And if you have other things you want to put in there, feel free to put it in there. If you have a small company or whatever, or a loan that you've given somebody, maybe you did a note, you can put a note in that section as well, which is a lot like a bond. I'd kind of put that in the same category. Now, going from left to right, put in liquidity as your first one. The next one, put in marketability, like we talked about. And then the next one, put leverage. Then put management. Then put taxes. Then put risk. And then put rate of return. I always put rate of return all the way over to the side because that's your hope, right? And right before hope, your risk is all the stuff that could go wrong. Tax guy comes first. You're going to have to manage the property. What kind of loan you're going to put on it? Do people want that particular asset? And how fast can you turn it, right? So it's progressively kind of works its way out with, I think, what's most important to what will be it's most important, your return, but ultimately that's, you're hopeful. That's a gauge that's up and down, or it's a target that you're going to. So let's talk about liquidity. And I would rate these from 1 to 10 while you're analyzing whatever you're analyzing. And you can take different pieces of real estate. Like if you have 3 different types of real estate, you can actually take those 3 different types. Like maybe you have assisted living, maybe you have apartment, multifamily apartment, and maybe you have retail, right? So those 3 different types of real estate will have different types of analysis based on how fast could I turn that? How many people want it? What's the demand? What kind of leverage can I get on that segment? How much management is going to be involved in multi-unit compared to retail, right? Or assisted living? What tax benefits do I get in each one of those sections? How much risk is in there for my risk tolerance? And then what's my rate of return in the different categories? So let's take the first one, savings. So savings, what's your liquidity, right? I would say from 1 being the worst, 10 being the best, the liquidity would be 10, right? You can take and withdraw the money right out of your savings account. You can move it to pay a bill. It's liquid. It's extremely liquid. So I'd put a 10 as far as savings, right? As far as marketability, it's, what's to market? It's like done, right? So, you're not going to get any more money for it. Savings is savings. right? Maybe you have another bank that might want your savings so they can leverage up that. But other than that, there's really nothing. Leverage. What can you leverage on savings? Well, you could actually borrow against savings. You can use savings as collateral. You can leverage against it. Usually it's the best you might be able to get is maybe a 1-for-1 on it, or maybe 50%. That they'll lock it up and they'll lend you out what they could take from the savings, right? You'd still need to be able to make the payments. Management, what management is there in savings? It's the best, right? 10, no management. Taxes, no tax benefit at all. So savings would probably be pretty tax neutral if you really think about it, money in a bank account. Risk, well, it's in the bank. If the bank fails, that's probably it, but you have FDIC as far as insurance goes, and your rate of return is probably going to be the worst in a savings account, right? It's the most liquid. Of course, you have all the positive aspects, no management, tax neutral, risk is extremely low, small rate of return. So because of all the other factors being high or the best, you get the least amount of return. So it's a very secure asset. So savings is really low rate of return. Now bonds can have a much higher rate of return. You might get a bond that yields 3%, right? So you bought a bond that yields 3%. And the bond may be strong and they're pretty liquid. You can sell them on the market. There's lots of people that look to buy bonds. But when you're holding on to a bond, typically you're waiting till a certain point when it matures. So if you wanted to sell that bond quickly, a lot of times you'd have to take a discount depending on how well that bond is performing. So the marketability is somewhat risky, right? Leverage, typically you're not really leveraging a bond. Leverage is too costly for a bond investor. The interest that you must pay on borrowing the money that you're leveraging your bond investment is generally going to be higher than what you're earning in interest on the bond that you're paying for. So typically you're not going to actually typically leverage against a bond because of the cost of it. Will cost more than the interest itself. There's no management in a bond. There can be tax benefits and for bonds, and that's something you need to talk to your tax accountant. Risk on a bond, if it's a corporate bond, you have obviously the risk of if that corporation goes out of business, but most of the time the bonds are secured against assets. So if it goes into bankruptcy, the likelihood of you getting that money back is probably pretty good. So you want to look at what is its marketability? What would somebody pay for it? Is it trading in the marketplace? Is there a lot of trading in the marketplace? And then also, you can also probably, with the bank, be able to borrow against bonds for a certain degree, because they'll collateralize those and say, well, if you don't pay, they can take that back. And your risk can be pretty low. They're graded, typically. If they're treasury bonds, it's the United States. So lately, before they were yielding really low, like savings accounts, because they really need the capital. As they need capital, they'll issue more bonds, and those bonds are converted into currency. And as they need that money, they'll raise what people get paid on those treasury bills, and that kind of gets people buying bonds again. So that's your rate of return can go up if the demand for bonds goes up, right? If it goes down, your rate of return can go down if you're trying to get out of it. Typically, you have a fixed amount, though, so you're getting that fixed, like, say, 3%. It's only when you're getting rid of it that you may have to discount it, or maybe you can even charge a premium, depending on what bond you have. So how do you calculate a bond, right? How do you figure the rate of a bond, the return rate? Well, to determine that, you're basically going to take how much interest you earned on the bond during the year by multiplying the face value by the coupon rate. And secondly, what you're going to do is how much value of the bond appreciated in the year. How much did it go up, that bond, right? Now, third, what you're going to do is add the interest rate to the price appreciation and divide it by the bond's price at the beginning of the year, okay? So the par value is simply the face value of the bond or the value of the bond as stated by the issuing entity. A bond coupon rate is a rate of interest per annum. So every year, how much that pays. So while the yield rate of return is generated by that, right? So let's say, for example, you have a $1,000 bond, and that's what's issued, and it says it's worth $1,000, and the coupon rate is 3%. Well, you're going to get paid about $30 in interest annually, right? So that's basically how you can establish and calculate a bond, both the return rate and the bond itself, its face value. So publicly traded stocks. Liquidity, you can look at the volume that's happening, in a marketplace. Typically when I'm looking at a stock that's traded, if there's a lot of volume and that volume is pretty heavy, right? I know it's really marketable. Since it's a stock and they get traded back and forth, the liquidity is almost, right away. You can basically sell something, so it's pretty fast. And you're typically not going to discount it much. Maybe your buy and sell has a little bit of variance, and you have to move a little bit, but it's generally not that much, especially if there's a lot of volume. So you can trade in and out of that stock pretty quickly. So it's got really good liquidity, pretty high, marketability pretty high if it's moving pretty fast. You can leverage stock to buy more stock as much as 10 times, right? So you could have a margin account where you're able to buy more stock, but you're going to pay interest against that for using that leverage. Management, you somewhat got to watch it, but you're not paying expenses towards it. You're not really handling anything that's publicly traded. Somebody else is dealing with it. If you have losses, you look at your tax treatment. There is some risk. I mean, they go up and down. You can put in a sell order to make sure you sell out if it drops below where you want it to. Or you can hedge against it by maybe I buy like shorts against something that I'm going long in, and I'll pay the fee on a short. So, and typically I buy stocks that are basically going to pay a dividend, and then I also look towards a company that's going to appreciate in value. So there is some risk, there is some volatility. Rate of return is, it's not predictable for the most part. So, but high liquidity, like a savings, pretty fast and marketable. Now, when it comes to stock, how do you figure your rate of return on a stock? If you, and there's a real simple formula for doing it. If you, let's say I bought $100,000 worth of stock, right? And let's say they paid a dividend, maybe they're real generous. This doesn't happen, but let's just call it 7%, right? They're paying out $7,000. So at the end of the year, that stock at the end of the year is $125,000. I put $100,000 in, and they paid me $7,000. What I'm going to do at that point is I'm going to take the 25 I made, right? I'm going to take the 7,000 dividend, and I'm going to divide it by what I actually paid for the stock. Now, in this particular case, I made a rate of return of 32% when you figure the stock appreciation, and then you also figure the dividend that was paid. That total return is basically 32%. So pretty attractive when you think about it. But the other case is, on the flip side, if I turn around and I have a stock that I bought for $100,000 and it's now worth $75 at the end of the year, and it paid me $7, I'm negative, what, 18% or so, or 17%? No, 18%. Yeah. So let's say I lost $25,000, they paid $7, that's $18,000. So $18,000 negative. I've lost about 18% overall, even though the stock's worth, $75,000. You add the $7,000, it's 82, which puts you at about 18% loss in your core. So it can work either way when it comes to the volatility of stocks are obviously there. Collectibles, on the other hand, pretty low liquidity, depending on the marketplace and how you can sell that, depending on the demand for the market and getting to the markets to be able to sell, being able to leverage that, because a bank has a tough time collateralizing that. So, it would be very tough for them to go after that. get it back from you. They can file a UCC1 against it, but still got to find it. Management, you got to take care of it, clean it, store it, make sure that it doesn't get damaged by the elements. It has different tax treatment, obviously. There's some risk. Somebody could steal it, and how do you get it back? And the rate of return is whatever the demand of that particular collectible is. So it's, you want to rate each one of those with different numbers based on where they're at so that you can get a good idea or a good feel when you analyze these characteristics. Precious metals, I buy gold, and gold I get at spot. So typically whatever gold is trading for, I pay $10 over spot. Spot price is what the market price is. So if it's $1,200, I'm going to pay $1,210. I'm going to get it at spot. And when I want to sell it, I can traditionally get it maybe $10 under spot. So I've got a fee of about $10 either way on precious metals. And there's a market for it. It's pretty liquid. Marketing it, it's not hard. There are a lot of people in the industry as far as gold goes. Leveraging it, a little tough again because of the fact that it is more like personal property. Unless it's in some sort of publicly traded instrument that then you can get leverage on. And maybe you can collateralize with the bank your account, right? So no real management. Tax has different tax treatment risks. You got to secure that. Make sure it's okay. Your rate of return, it's only if it goes up. It doesn't have cash flow. It doesn't, but at the same time, it really doesn't have any big expenses. And small amounts of gold are easy to store and easy to capture that value and trade that value. So gold for me is definitely something that I have. I would suggest that I would tell any one of my family and friends that it's probably a good idea to buy precious metal and hold a little bit of it, like maybe 10 or 20% of someone's money, I would say. To my friends and family, that's definitely what I would recommend they do. Now, real estate, my favorite. Real estate has some unique advantages to it. Typically, it's not as liquid. So your liquidity is pretty low as far as being able to access that cash right away. So if you're stuck in something that happens in the marketplace and it turns down and buyers disappear because they're scared, because greed is not nearly as powerful as fear. Fear is a lot bigger emotion than greed. So when people are afraid your buyers could disappear and you could find that your real estate is not that liquid, banks can stop lending in a subcategory. You can't find a loan for it. So liquidity can change. The flip side of that, it's very traditional for people to invest in real estate. Banks are comfortable with it. They know it. Law firms, we know, you put a deed against the property, the money is there, the property isn't going anywhere. You can secure it, collateralize it. So traditionally, it's a very powerful tool to hold wealth, real estate is. Liquidity, it's there. It just can take maybe 90 days, 30 days to transfer title, get all the lending, get everything, because most people don't just trade cash for real estate. It does have a certain marketability, but then again, you're going to want to know, what is this market segment as far as the segment of real estate doing, and what is the submarket doing? How fast is that submarket trading? You can have an industrial submarket near an airport that's doing incredible, and then you could have one that's way out on the outskirts of town that nobody's buying anything. So no matter what you market it for, and then your marketability is like the worst for that property, but the best in another submarket. So you want to break up those markets as well, the type of real estate, the subcategory, and then it's location, location, right? You've heard that before. So leverage. You can leverage real estate almost better than any other asset. Typically, most of the commercial stuff, you're looking at about a 65% loan to value, or loan to cost, or loan to build, depending on which one. Usually the banks now go for the lowest one. Used to be before the market in 2008, they would take the highest one and they would roll with it. But ever since the market crashed, they've gone to what's the lowest common denominator between what it costs to build, what the value of it is, or what's the income approach. Those two different approaches determine the values, income, market, what somebody's willing to pay for it, and what it costs to build and replace that product. They look at that, they take the lowest number, and will give you typically about 65%. So you're able to leverage up that real estate. And the other thing is the rate that they charge for real estate leverage is very inexpensive compared to all the other items. If you wanted to leverage any of the others, it could be pretty expensive. But leveraging up real estate traditionally is the best. The other thing is there's lots of tax implications that are positive. So you got good leverage. There may be some management involved, so you really want to take a look at what kind of management you have to deal with. Are you going to pay somebody? This is where scale makes a big difference too. If you buy a fourplex, if 2 units are empty, you're going to have 50% less occupancy, means 50% typically less rent. The expenses typically don't change. So ultimately, you could have an asset that now is a liability or costs you money until you fill that up. You take the same type of concept across 200 units, and if a few go vacant and then you replace those with people, the likelihood of that asset turning negative is probably going to be pretty low, and you can afford management, right? So you can afford to pay for management and have somebody else handle the day-to-day. I suggest that because it's typically not as emotional. People that have their own real estate, you should watch a movie called Pacific Heights. People get really emotional about real estate when it's their own, and they take it very personal when stuff happens to it. And that kind of personal aspect of it really puts you in a liability situation compared to if somebody else is handling management. You can always fire and get new management, or you can get a new management team. But if it's you and the buck stops with you, it's probably not a good position to be in. Me personally, that would be my suggestion to you, is buy scale, right? Or invest at scale with people. Be a piece of several people investing rather than trying to do it all yourself and be the hero and end up fixing your own toilets. So I would suggest buy at scale. Your tax, you can typically write off the interest payment and you can depreciate the asset. Again, talk to your tax accountant. I know me personally, my tax guy is taking like a 39 straight year depreciation, and then the interest I pay, we actually get to write off, and the expenses. So I only pay on the income that drops to the bottom line, which is very different than other types of money that you would make, right? That you may have to pay taxes on the full compared to on the net. Pay taxes on the net at the end of the paying all your expenses. So this gives you a good idea about how to lay out the characteristics, right? Your liquidity, marketplace, leverage, management, taxes, risk, and your rate of return. And the good thing is map this out, write down your instruments, as many as you can, and start playing with these numbers and think with it. Start thinking with that. You want to add a couple extra columns. This is just the basics. You can add 10 more if you want. You can add sub-markets to that. You can add, you know, as far as on the rate of return, maybe it's sub-market category and how strong you think it is, and maybe it's type of category of the real estate that it is, or if it's silver or gold, what you think those different sub-markets are for that particular precious metal. So this is really to get you thinking and start to analytically put numbers to managing your risk, your marketing, your like idea of how do I break this down. So it isn't just from your gut. You want to really externalize this, and then also talk to people, you know, ask for input. What do you think the liquidity of this is? Talk to a couple of different real estate people. Talk to a couple of different precious metal brokers, right? Talk to a couple of different stockbrokers, you know. What is this? This is a team sport. When you went to school, yeah, you went to school, you had to study something, and you test by yourself. But once you got out of school, it's a team sport. You can share. It's not called cheating anymore, right? You can literally share information with each other. You can talk to somebody. You can ask for their input. You can ask for how they would break something down. Like literally, don't do it all yourself, right? Get help, right? A lot of times it's just having a good conversation with a professional, and the professional, because they want to probably get your business to some degree, will help you any way they possibly can to get you to steer towards using them and helping you, right? Like if you came to me and asked for real estate advice or needed some help with something or some consulting on it, my hope would be that you would use me. If it's buying a business, my hope would be that you use me. And you can do the same thing with this as far as breaking down a business. How many people, want this business? How fast can I sell it? What can I borrow against it, right? Like, for example, on an SBA loan, I can get 90% loan to value typically on the business. Management, you're probably going to be running it, right? Tax implication, typically you pay taxes on the net. See a tax professional, obviously. Your rate of return can be variable. Typically in businesses, we look for a 33% return, basically, which is pretty simple for a small business, right? So break it down, analyze it, grade it, give it 1 to 10. Look at your matrix, add it up, figure out which is best for you and what you're comfortable with, because you may be not comfortable with a product that doesn't have a lot of liquidity. I know lots of people that if the product is not liquid, they don't feel comfortable. They need to be able to grab that right away. Well, real estate's not for you, right? Because there's a process to exiting out of that investment. Precious metals, people may want to hold on to that. They don't want the real estate over off somewhere else that they can't necessarily. They don't want to hold that gold as close as maybe they carry it every day with them, right? So, or a collectible they want it on the wall where they can look at it every single day and they got security cameras. This is not for me to tell you how to invest. This is simply to talk about analytically opening up your mind to how to break things down as far as investment goes. At least 7 different categories that you can break it down and then add more to it. Whatever you think matters, and depending on the asset class, they'll have different characteristics. So I hope this was helpful, and we're going to be diving into more of this stuff, but this is to give you a real basis to be able to start right now analyzing what's in your life. Analyze what your life is like right now. Analyze your savings, your bonds, your stocks, your collectibles. What do you have on the wall? What if you decided to sell it on eBay or OfferUp? What would be the value of each of the items that you have? And what about the real estate you live in? How liquid is it? How fast is it moving in the marketplace? Is it trending up or down in the marketplace? How much leverage do you have against it? Do you have the right leverage? Did you borrow correctly, or do you need to shop your loan? Right? Could you get an equity line against it and use it to invest in something else? Right? If you have a business, are you leveraged there? Could you pull money out of there to be able to buy the real estate you're in and be able to make more wealth? Right? All these things are stuff that you want to confront. You want to really take a look at it now, right? In this unit of time, and break down where you're at. The sooner you start looking at this stuff, the sooner you start confronting and talking about it and looking at your house, looking, should I downsize, should I upsize, should I, add 3 or 4 houses to that? What lending can I get? You start to realize how all this works, and you get in the conversation, and that's what it's all about, is now get in the conversation. Do it now. Understanding the characteristics of an investment is not enough. You need more than that, right? This is where the rubber meets the pavement, and that is the cash, right? So what's the money? And you really want to take a look at the money. What's it cost to buy the particular, and I'm digging into real estate, what's it going to cost you to buy that piece of real estate? You got to look at the expenses that come into it, the title, the taxes, all the items that add up to the total purchase price of that particular piece of real estate, not just the sales price. What's it going to cost you for the taxes? What's it going to cost you for the transfer tax? What's the escrow going to cost you? What's the loan going to cost you? You want to add all those total up, because that's your total. It isn't just that net number that you're paying for it. It is a bottom line number, the whole deal, everything. That's how I look at it. A lot of people don't look at it that way, but I look at the entire deal, all of it. And package all of that. I use what's called a T-bar, and I'll talk to you about that in just a second. But first, you want to figure out, what's my total investment into it? All of it, right? The next thing you want to do, because right when you close escrow, that money is locked into an investment, the time is ticking. You want to know, what's my cash flow going to be, right? You want to know your time horizon. And it's very important, a lot of people don't think about this. When they're putting the whole deal together, and I mean the whole deal, that means from the beginning to the selling, to when you dispose of that property, your disposition, right? When you get to that time when you're totally out of the project and your hands are clean and you have no liability and you also have no more money coming in as well. What is that whole picture? So right now I'm focusing on, it's not enough just to know these characteristics and how to grade stuff. You need to look at how much am I totally putting into this project? What are my cash flows? So for example, I do a T-bar, make a bar that's just like a T, put an N on one side, that's your net cash flows, and then you have a dollar sign on the other side. You put 0 as the first number, and then whatever your investment, I'm going to pick a round number like $1,000. You're going to put parentheses around that. That's your negative because it's coming out of your pocket, right? So you now are invested in this deal. So let's say year one, you made $500. Great, that's cash flow year one, $500. Second year, $500. Third year, $500. You had a time horizon of 5 years. You made $500 cash flow after expenses because you want to figure out, okay, what's my operating expenses? What's my cost? What's my ownership? How can I write off whatever I'm going to write off? Then at the end of it, now this is just a cash basis number. We haven't factored in all the tax benefits in this. This is just clean cash that we're talking about, not with any of the other stuff that we'll talk about later. But right now, that $500 for 5 years is $2,500. Now I'm going to say that this asset went up by $500, and this was totally, you didn't pay any principal down, so you're selling it for $1,500, something you bought 5 years ago for $1,000. Now you add up your cash flows, $2,500 plus the $1,500, come up with about $4,000, minus the $1,000, your total return on this entire investment was $3,000 over a 5-year period for a $1,000 investment. Right? So you want to take in, this is a very clean look at the cash flow. This doesn't take in all the nuances of the tax benefits or the writing off the interest or the depreciation. This is just simple math, right? Cash flows, adding it up, getting in and out of an investment. Maybe I set my term at 10 years, which I think is smart, not a 5-year term because I don't want to have to get out of this investment at 5 years. But I also don't want to be penalized when I come out of it in 5 years. So if I do a 10-year term and I say, look, no penalties if I pay early, some loans will have penalties for paying early. So you definitely want to ask your lender, is there a penalty for paying early, right? But that's a simple way to look at a T-bar. What's all your money going in? What are your cash flows on it? Make that time horizon. Pick the date you're going to get out of it, right? And think about up front. Most of the investors I talk to don't ever think about exit. They only think about entrance and hold, right? How long are you going to hold it? Maybe you want to take and 1031 exchange this into something bigger, or you want to move it around, right? So you really want to pick that time horizon and pick your date you're going to get out, because knowing what your exit strategy is helps you determine what kind of loan, whether you're just going to simply get and pay down no principal. If it's a long hold and you want it paid off, then you want a fully amortizing loan, 25 years, maybe from an insurance company, and you make your payments, so that when you're done with that investment in 25 years, it's paid off. Maybe that's your retirement. Fine. And maybe you're going to sell it then and live on the cash. Or maybe you keep the cash flow coming in, knowing that you got the building paid off and you're going to pass on the building to your heirs. There's lots of different strategies there. And of course, ownership is going to be really important when you decide how you're going to handle that asset as well, to be able to move whatever you have into someone else's, like a beneficiary, how you're going to handle that. All those things are things that you need to think of before you get into an investment, not when you're deep-seated into it and you're like one family member I know of, I won't mention any names, that had an $800 million empire, real estate empire, and then all of a sudden needed to transfer all of that to his kids, and it had basically they would have taken a 50% hit on death, the death tax basically when you die, and how much the limits were to transfer into the kids. So they had a huge problem because they didn't plan, They didn't think like, okay, where are we going to be and how do we deal with what when we get there, right? So that time horizon is huge. It's not for me to give you legal advice or tax advice, and nothing I say I want you to construe as legal tax advice, or if you want real estate advice, you're gonna have to come in and I'll work with you and help you, and then you can basically, the services, I'll make a commission or whatever on. So basically, I'm giving you what I do when I look at investments and how I look at them. So that if you like what I do, you can have similar results than I have, but there's no guarantees. I don't make any guarantees in this. So your guarantee is that if you don't play, nothing can happen, right? So, but if you have some tools, your odds of actually doing something positive are probably better than if you have no tools at all. If it costs you $1,000 to get into the investment on top of that in fees, and it costs you $1,000 to get out of it, and your net was $1,000 over 5 years, maybe you don't want to do that deal now. So you want to look at all of the numbers, both coming in, during all your cash flows, and going out. And that gives you the whole picture of your entire investment. I hope this helped. Now is the time to start looking at this stuff. Analyze your existing. You have a T-bar in your life right now that you can talk about your own real estate. And if it's your own personal property, typically it's what you put into it, and you got negative cash flows every month you got to overcome. So that property is going to eat you. You want to go get cash flowing property that will help you pay that T-bar. So it's not always going to be positive, right? You're not always going to put money in and have positive cash flows and then exit positively, right? So I don't want you to think fixated on that. There are different times when you're actually going to go negative, right? So let me talk about what time that could be. If you're buying, like, say, a fixer-upper, right? Your initial capital into the deal could be, let's say, $50,000. Maybe the house is worth $100,000, totally fixed up. And each month you're going to be putting $5,000 into the property. And you go 4 months and basically you've paid $20,000 plus the $70,000, and then you're going to sell it for $100,000 minus your proceeds. Now, all of this has been negative so far. You don't plan on renting it, you're just fixing it and flipping it. So you've had a negative investment, you had negative cash flows. In fact, you've had to put more money into it, going into it, but your goal, your total time horizon is 6 months, let's say, and you'll be in and out of that, and maybe you're paying 10% on your money because you're using like bridge capital or flip financing. They have different products out there that you can use. So you're in an investment and you're out of it within 6 months. So all your flows are negative. And the bank's even okay knowing that this property is not going to cash flow because you're getting it 50% loan to value, right? Or 60% loan to value in a pretty hot, stable market. So now we have a T-bar that, yes, you want to do it. Yes, you want to check all your money in, your cash flows, and your exit. But ultimately, that entire T-bar is going to be negative, right? So you don't want to have like a fixed thinking. You're looking for your agenda or goals. If that particular investment strategy works with flipping, right? Your home typically is going to be something that you buy and is going to have negative cash flows, but you're going to pay down a loan and ultimately probably sell it, and it's like a forced savings account that you paid interest and you had a place to live. So it's not necessarily an investment, what I would call a true investment. I call true investments, they feed you, they don't eat you. They don't cost you money, they make you money every month. To me, that's a good solid investment. But a home still has its unique values that attribute to your overall financial health, right? But the other way too is you might have negative cash flows for the first couple years, and then you'll have a turning point. Maybe you've had some investors that you've got to pay back that you use for the down payment. So you might have an overall investment period, and then you have a second, which is to pay back those investors over the first year that put maybe 10% down or 20% down into the deal, and you're going to take negative cash flows on that because you're going to pay them off. And the bank's going to get their money, and maybe they took a second, or maybe they were just on the LLC and you're paying them off. That can be a T-bar that maybe is net neutral, meaning you don't make any money. You take all the proceeds and you're paying back the people so that you can then get to the point where you're positive cash flowing. So this T-bar, you need to be flexible in your thinking. This is just to break down the look of it and what it looks like, so you have it on paper and you know what it looks like, and you know how to basically work with it. But sometimes you'll make money, sometimes you can even lose money, but ultimately your goal is to make money in both scenarios. This is just a way to analyze your cash flows on a month-to-month, year-to-year basis.